Welcome to our second in a series of three courses on the subject of auditing. Today, in Lesson 1, we discuss the first two chapters taken from the middle part of the text. These cover evidence and substantive testing. When the auditor collects evidence, it must first be appropriate. To be appropriate, evidence must be persuasive, valid, and relevant. Auditors are not generally required to authenticate documents. Neither do they have to have convincing evidence. The point here is to present a case based on limited sampling. Auditors may accomplish more than one objective with a given procedure. Some objectives may require more than one procedure to accomplish. The text provides three groups of financial assertions. The first is assertions about classes of transactions and events. Occurrence. Recorded transactions must have occurred and must pertain to the business entity being audited. Completeness. All transactions that occurred have been recorded. Accuracy. Amounts have been recorded appropriately or accurately. Cutoff. Events are recorded in the correct accounting period, according to the accrual system. Classification. Transactions are recorded in the proper accounts. The second set of assertions are about account balances at period's end. They include existence. Assets, liabilities, and equities must actually exist. Rights and obligations. The entity actually controls assets and actually owes the obligations. Completeness. All assets, liabilities, and equity have been recorded. Valuation and allocation. All three are recorded at the proper amounts, and appropriate adjustments have been made to these amounts where needed, particularly for year-end closing. The third set are about presentation and disclosure. They include occurrence, the disclosed transactions have actually occurred. Completeness, all disclosures have been included. Classification and understanding, financial information is presented clearly and understandably. Accuracy and valuation, the financial information disclosed shows the correct amounts. Evidence must also not only be appropriate, must be reliable. For example, directly obtained evidence is more reliable than that obtained indirectly. External evidence obtained from independent sources is more reliable than internally generated evidence. Financial statements processed from accounting data under conditions of adequate internal control are more reliable than those under weak controls. Written evidence is more reliable than oral evidence. Finally, evidence should be sufficient. Conditions that require greater quantities of evidence include the following: greater inherent risk, greater control risk, a lower materiality level, higher expected levels of fraud and error, and a lower reliability of evidence. All of these require greater quantities of evidence to overcome the risks presented that there will be errors or omissions. Cost-benefit considerations and difficulty in obtaining evidence are not sufficient reasons for omitting procedures deemed to be necessary. That these are indicated as required under the circumstances as being needed, and so although we are there to make a profit, more importantly we're there to render a complete and professional service. Underlying accounting data is not sufficient to support financial statements. Corroborating evidence is also needed. This takes the form of checks, invoices, contracts, minutes from meetings, confirmation letters, bank statements, and written letters of representation. Note, certain electronic data may not be retrievable after the passage of time and may require testing several times per year. When data are electronically transmitted, processed, maintained, or accessed, the auditor may determine that it is not possible to reduce detection risk to an acceptable level. If this is indeed the case, we may perform tests of controls or indicate the issue in the audit report by issuing a qualified report or with a disclaimer statement. The auditor can also employ certain software to extract evidence from the client's database. And these are discussed very briefly. We'll try to take a look at that in class. Chapter 2 presents substantive tests. These are procedures that are meant to detect material misstatements and are used to obtain appropriate and sufficient evidence to support the auditor's opinion. We noted those were required for evidence that it be appropriate and sufficient. A list of procedures and their objectives is presented that includes substantive testing and about 6 or 8 others. We will examine these in class rather than discuss them all here on the video. It's quite lengthy. Substantive testing usually focuses on the balance sheet. Assets are tested for overstatement, that is, too many assets listed, not verifiable, or on the other hand, liabilities are generally tested for understatement. The opposites are possible, but less likely. An example is given to you in the text. The auditor may directly test financial balances in a number of ways, for instance, by recalculation, confirmation, or observation. Another procedure is to perform footing and cross-footing, and this is described as adding columns of numbers and adding across columns. Other procedures listed and described in Chapter 2 include inquiry, inspection, review, confirmation, analysis, recomputation, observation, and performance. Be sure you read both chapters in their entirety. Take a look at the questions at the end of the chapter. I know we laugh, they don't actually look like questions, more like answers, but they do contain important information for you to pass the test. We will proceed as we did in the first class with a grade based on a combination of your discussion question essays or mini essays, paragraphs, and your sample test questions, how you answer those. I look forward to having a very fruitful and productive class with you this term. I look forward to meeting you all on Tuesday night, which is our new night for this class. Thank you very much.